Welcome back, everybody. Today we're going to do a deep dive into something a lot of you've been asking about. The FT Vest Laddered Buffer ETF, ticker symbol BUFR. We're doing this one because you're trying to figure out, how to maybe protect yourself from big losses in the stock market. Maybe you got a big financial decision coming up. Or maybe you just you're really fascinated by how these unique investment strategies actually work. So either way, we've got a bunch of info lined up for you today. We've got BUFR's profile page on ETF database, their fact sheet analyst reports, and even some insights straight from the ETF provider's website.
That sounds like we got all the ingredients for a fun exploration here.
Absolutely. So let's just start with the basics. What is BUFR?
So at its heart, BUFR is an exchange-traded fund, an ETF. It was launched back in August of 2020 by First Trust. And ETFs are really popular because they let you invest in a whole basket of assets all at once, just like buying a single stock.
Oh, instant diversification.
Right.
Yeah. But BUFR has a twist to it. It's designed to basically act as a buffer against the first 10% of potential losses in the S&P 500. So it's kind of like,
Wow.
having a built-in safety net.
Exactly. And that protection comes from the way BUFR invests, not by some magical force field or anything.
All right, so it's not like it's directly creating a shield. It's more about what's underneath.
Exactly.
But what about the name? The FT Vest Laddered Buffer ETF. What is with this laddered part?
That's a key part of how this thing works. It actually holds 12 other ETFs, each one focused on a different month of the year. So imagine spreading your risk over time like rungs on a ladder. And each of these monthly ETFs aims to match the S&P 500's returns, but only up to a certain limit while simultaneously buffering against those initial losses.
So each month has its own little safety net. I like that. So can you walk me through how this kind of rolling system plays out, especially for someone who's maybe a little bit risk averse?
Sure. So let's take a look at BUFR's holdings as of January 13th, 2025. To kind of illustrate this, the January ETF, ticker symbol FJAN, only has 4 days left in its outcome period. This means its upside potential is extremely limited at just 0.06%. However, it still offers a buffer of 11.72% against any losses.
Interesting. So even in those last few days of its cycle, it's still providing that downside protection.
Now compare that with the December ETF, FDEC. It has a much longer runway, 340 days left, and a much higher remaining cap of 14.94%, giving it more room to grow if the market does well. But the trade-off is a slightly smaller buffer of 8.56%.
So as we go further out on that timeline, you have more potential upside, but maybe a slightly smaller safety net. I'm starting to see how this ladder structure kind of creates this more consistent experience, even when the market is bouncing around.
Precisely.
But the question is, does this design actually translate to better performance?
Right. Let's see what the data tells us.
All right, so let's dig into those numbers. Did BUFR deliver on its promise of a smoother ride?
Well, according to ETF database over the past year, BUFR gained 13.77%. which actually beat the S&P 500's 9.99% return for the same period. However, it didn't quite keep up with the S&P's overall 25.02% gain. And looking back over 3 years, BUFR is up 8.31%. Again, better than its peers, but trailing the S&P 500.
So it's kind of a mixed bag. It seems like, BUFR might provide some stability, but potentially at the cost of missing out on those bigger gains when the market is really hot.
Yeah, it's important to remember that BUFR prioritizes downside protection. So this means it might lag behind in super bullish markets, but outperform during downturns. It really depends on what you're looking for as an investor.
Yeah.
Like a wild ride with potential for big wins, or a steadier, more predictable path.
Yeah, absolutely. Speaking of what's under the hood, one thing that struck me when I was looking at the holdings is that BUFR only has 14 total holdings listed. That seems pretty streamlined.
It does. And remember those 12 monthly buffer ETFs we discussed?
Yeah.
They make up the lion's share of BUFR's portfolio, over 83%. There are also 2 very small holdings for cash management purposes, likely just to keep things running smoothly.
Okay, so it's really laser focused on this laddered approach. And that means that the success of this whole strategy really hinges on how well those 12 ETFs actually perform. It's a lot of trust in one basket.
Absolutely. It's
All right.
definitely something to consider when evaluating this ETF.
For sure. And speaking of things to consider, what about the cost of this downside protection? No investment is free.
Right. Good point.
What's the price tag for this potential peace of mind?
So BUFR has a net expense ratio of 0.95% per year. That means for every $10,000 invested, you would pay $95 in fees annually.
Okay, so that is higher than the average for similar ETFs, focusing on large U.S. companies.
Yeah.
Their average is beats on 7.2%, and the broader category average comes in at 0.61%.
It is, you always have to weigh the costs against the potential benefits. Is the downside protection worth the premium? That's a key question to ask yourself as an investor.
Yeah, okay, so we can see that BUFR is a specialized tool. It's designed to smooth out that market volatility, but that could mean missing out on those big gains when the market is soaring. Plus, there's the higher cost to consider. But before we wrap up part one of this deep dive, I want to pause for a second and kind of connect this back to you, the listener. How could this potentially fit into your overall portfolio?
Right. That's the million-dollar question.
Yeah. Would having this potential safety net make you feel more confident, even if it meant slightly lower returns in a bull market? Or would you rather ride the waves and, take the good with the bad?
Right, we've covered a lot of ground in this first part, focusing on what BUFR is and how it's structured. But to really understand if it's right for you, we need to dig deeper into those underlying ETFs and how they actually work.
All right, so let's get into the nitty-gritty. In part two, we're going to unpack those monthly ETFs and see what makes them pick. So now that we've got a pretty good understanding of BUFR itself, let's zoom in on these kind of intriguing underlying ETFs that power this whole investment strategy.
Yeah, the ones actually doing the heavy lifting when it comes to buffering against those losses.
Exactly. They're the key to this whole operation.
Exactly. Each of these 12 FT Vest U.S. equity buffer ETFs with ticker symbols like FJAN for January, FFEB for February, and so on, each has its own specific job to do. The goal is to match the S&P 500's performance, but only up to a certain limit, all while providing that built-in protection against a set amount of losses.
It's like each month has its own little bodyguard, protecting a portion of your investment. But how do these individual ETFs actually accomplish that? We talked about this outcome period before. Can you break that down for me?
Sure, so think of the outcome period as the time frame. When each ETF's buffering strategy is in full effect, it's aligned with the calendar month. So the January ETF's outcome period starts on January 22nd and runs until January 17th of the following year.
So it's like a relay race where each ETF kind of takes its turn. Protecting your investment, what happens at the end of each outcome period?
So at the end of its outcome period, the ETF essentially resets, and a new outcome period begins with a freshly calculated cap and buffer based on current market conditions.
Got it. So it's not like a static set it and forget it system. It's constantly adjusting to the market's ups and downs. That's pretty cool. So what other insights can we get from looking at these ETFs?
When we look at BUFR's holdings on January 13th, 2025, we get a snapshot of where each of these monthly ETFs stands. For instance, the January ETF, FGAN, only has 4 days left in its outcome period. This means its potential for growth is extremely limited, with a mere 0.06% remaining on its cap.
So those last few days are all about maximizing that protection, not growth. It's battening down the hatches before the reset.
Precisely. But it still offers that substantial buffer of 11.72% against any losses during these final days. Now contrast that with the December ETF FDEC. It still has a long way to go, 340 days, and a much higher remaining cap of 14.94%, giving it a lot more room to run if the market continues to climb.
So as we move further out on the calendar, we see a shift towards more potential for gains, but with a slightly smaller safety net. It's a fascinating balancing act. What about those downside before buffer numbers I see listed? What is the significance of those?
That's an important detail to understand. The downside before buffer tells us how much the S&P 500 would need to drop before the buffer for each ETF kicks in. It's not like the buffer is always active. There's a threshold that needs to be crossed first.
So it's not just a constant cushion, it's more like a safety net that deploys when needed.
Exactly.
Wow.
On January 13th, for example, the January ETF had a downside before buffer of negative 13.62%. That means the S&P 500 would need to fall by over 13% before that 11.72% buffer starts doing its job.
And of course, that threshold is different for each ETF, depending on where it is in its outcome period.
It's all dynamic,
Don't
remember?
worry.
As the outcome period goes on and the market fluctuates, the downside before buffer will adjust accordingly. And that's what makes this laddered approach so unique. It's not a one-size-fits-all strategy. It's constantly adapting to market conditions.
It's almost like having a financial advisor constantly monitoring your portfolio and adjusting the level of protection based on the market's mood swings.
That's a great way to think about it. A lot of thought and ingenuity has gone into structuring these buffer ETFs and how they work together within BUFR. But as always, the most important question is whether this translates into real benefits for investors. To understand that, we need to shift gears a little bit and look at BUFR's investment objective and strategy. What is this ETF ultimately trying to achieve?
Okay, so let's get into BUFR's DNA. What's its core mission? So let's get down to like the heart of the matter here. What is BUFR actually trying to do, according to its creators?
So the main objective of BUFR, as stated on First Trust's website, is to achieve capital appreciation while providing exposure to large U.S. companies. But most importantly, it aims to limit downside risk.
Okay, so it's not just about chasing those huge returns. It's about finding that balance between growth and protection.
Yeah. Exactly. And how BUFR tries to do this is really what makes it stand out. It invests almost all of its assets into those 12 underlying Vest U.S. equity buffer ETFs we've been exploring.
Right, so those monthly ETFs are really the engines driving this whole strategy. BUFR itself is more like the framework that kind of holds them together.
That's a great way to put it. And BUFR doesn't try to directly replicate those caps and buffers we discussed earlier. It simply aims to offer investors diversified exposure to all of them, neatly packaged in a single investment.
So it's kind of spreading its bets across different downside protection strategies, each one fine-tuned for a specific point in the year.
Exactly, and this brings us back to why understanding those underlying ETFs is so crucial. They are the ones actually providing the buffer against losses in the S&P 500. BUFR itself doesn't inherently offer any protection. It's just the vehicle for accessing those unique monthly strategies.
Right, it's like the delivery truck that gets those special packages to your doorstep. You know what I mean?
I like that analogy.
The document also mentions something called delta. And I remember seeing that term when we were looking at the holdings data. Can you explain what that means and why it's important?
Sure. So delta is a term from the world of options trading, and it measures how much an options price is expected to move for every dollar change in the underlying asset. Think of it like this. A high delta means the investment is likely to move more dramatically, while a low delta suggests it's less sensitive to swings in the market. In BUFR's case, the weighted average delta gives us a glimpse into how sensitive the entire portfolio is to changes in the S&P 500.
Okay, so a higher delta for BUFR means it's probably going to jump around more when the market fluctuates, while a lower delta suggests kind of a smoother ride.
Exactly. According to First Trust, BUFR's weighted average delta as of January 13, 2025, was 51.64%. But historically, it's been around 43.49%.
Interesting. So it seems like BUFR's sensitivity to those market swings might be decreasing a little bit. Do you think Vest Financial is intentionally trying to dampen that volatility, maybe in response to like current market conditions?
It's certainly possible. Remember, this is an actively managed ETF, so that means there's a team making decisions behind the scenes that can impact performance.
So it's not just on autopilot.
Right.
Okay, so let's revisit BUFR's performance track record for a second. We saw earlier that it's had respectable returns, but not always as high as the S&P 500. Is that just the price you pay for this downside protection?
Well, as we've discussed, BUFR's main objective isn't to chase the highest possible returns. It's more about providing a smoother, more controlled experience, even if that means potentially missing out on some gains when the market is surging.
So you might be giving up some of that upside potential, but potentially sleeping better at night, knowing you've got that buffer in place.
Precisely. First Trust actually provides some hypothetical growth data for BUFR since its inception. Of course, it's important to remember this is just a projection, not a guarantee of future results, but it gives us a general idea of how BUFR would have performed compared to the S&P 500. Assuming you invested $10,000 back on August 10th, 2020, when the ETF launched.
Okay, so hypothetically, how did those $10,000...
As of December 31st, 2024, that initial investment would have grown to $10,997 based on BUFR's net asset value. The S&P 500, on the other hand, would have turned that same $10,000 into $11,535.
So BUFR lagged behind a little bit, but it still delivered a solid gain over that time period.
And don't forget those returns for BUFR include the fees and expenses, which are a bit higher than average as we discussed earlier. So the performance gap isn't as significant as it might appear at first glance.
Yeah, it's important to keep those costs in mind. So we've covered a lot of ground today exploring BUFR from all angles. As we wrap up this deep dive, what are the key takeaways you hope our listener walks away with?
Well, I think the biggest takeaway is that BUFR offers a unique way to approach investing in the market. It could be a valuable tool for someone seeking a smoother ride and greater peace of mind, especially during times of uncertainty. But it's not a magic bullet. It's crucial to remember that you might be sacrificing some potential for big gains in exchange for that downside protection. And the higher expense ratio is something to factor into your decision.
It all comes down to your individual goals, risk tolerance, and what you're hoping to achieve as an investor. BUFR might be a great fit for someone who prioritizes stability and protection, while someone else might prefer a more aggressive approach.
Exactly. We've explored the mechanics of BUFR and how it works, but the real question is, does it align with your investment philosophy and goals?
So if this deep dive has kind of sparked your curiosity, there's always more to learn. Dig into Vest Financial's track record, examine the specific holdings of those monthly buffer ETFs, and just consider how this strategy could potentially fit into your overall portfolio.
Yeah, knowledge is power. The more informed you are as an investor, the better equipped you'll be to make decisions that align with your individual needs and goals.
Couldn't have said it better myself. Well, thank you so much for joining us on this deep dive into the world of BUFR. We hope you found it informative and insightful. Until next time, happy investing.